So I'm Jeff Huzak, and welcome to the April 2021 Market Update webinar. And let's get started. So this is the disclosure slide that we always have to put up. Obviously, investing involves risk, including the potential loss of principal. No investment strategy can guarantee profit, protect against loss in periods of declining values. These are all the states that we're currently registered in. So leave this up for a few seconds here so we can kind of read through that. And then here's a little breakdown on me. Jeff Huzak, 2 professional designations, bunch of security licenses as well. We manage money for individuals, families, as well as small business and corporate retirement plans. That's our address, phone number, email, and I think this slide's at the back as well. So, but most people on here should have my contact information. So, okay, topics to be discussed today. So there's a few more topics this time around, but I'm actually going to go through the slides a little bit quicker than I have in the past. So bullish versus bearish argument, we kind of always start with that. Global growth projections. I'm going to take a look at small cap strength. I'm going to also take a look. I haven't shared this chart with you guys yet, kind of an all asset momentum breakdown. This is something that I created, I don't know, maybe 6 or 7 months ago. And I've started to use quite a bit in our process a little bit. And then quick volatility update, not too much to talk about with that. So just touch on that briefly. Offenses versus defense update. Dollar versus commodities, kind of interesting what's going on in that field right now. And then momentum, just the S&P 500, just look at overall momentum and kind of look at where we're at and kind of, where I think we need to get to kind of keep things going in the right direction. Okay, bullish arguments. Obviously, this has been, tops of the list for the past few webinars, global awakening and kind of reopening, right? Just the world reopening, emerging markets starting to pick up steam, international, which, those areas haven't done much for the past, 12 years or so. And then just, reopening across the U.S. economy as well. Momentum still strong. Everything looks pretty good. Nothing too concerning there. Low interest rates, obviously still historically low, but rising. And there's some issues there with, maybe some inflationary issues. Global asset shortage. I've touched upon that a little bit in the past. And then, as I mentioned last time, small cap strength as well. We have, let's see here. Somebody I saw just, and then bearish arguments, U.S. equity market stretched, inflationary concerns, signs of some reckless investing, kind of like a 2000 bubble, COVID variants, and then seasonality. So typically when I talk about seasonality, there's an old adage when investing, it's sell in May and go away, meaning that the summer months are typically more volatile and doesn't show as, historically doesn't show as much growth. And so we're coming into that, it's not that that's always the case. It's just something that has, from a historical aspect has happened. So just, from a seasonality aspect is something that people do pay attention to. Let's see here. Okay. So this is a chart from the IMF, the International Monetary Fund, and World Economic Output Update. This is as of January 2021 growth projections, right? So we've got this, I don't think this is anything too surprising here. Obviously last year, for obvious reasons, tough year, but significant growth projections for 2021 and even 2022 doesn't look terrible at this point is what they're projecting. Now, this is obviously just a projection, so it could change, but I think this is one of the reasons we're seeing asset prices rise, specifically commodity prices as well. And if you look, really, it's, and I've touched upon this about how, emerging markets and developing economies have really done nothing for the past decade. And so that's huge to see a big spike from them. I think that could really help push just the overall markets forward for, not only next year, but continuously over the next 5 years or so. Even if the U.S. market does correct, emerging markets and developing economies have really underperformed over the past decade. So you could see those hold up a little better if that does happen. So can I go to the next one here? This is a chart, weekly U.S. gasoline demand. Okay, so this is going all the way back to July. This is a weekly chart going all the way back to July. Here's the past few weeks, right? This is as of March 7th. So this is cut off of March 7th. That was the latest update from this particular source, and huge spike here. And the interesting thing about this is that this particular week was actually almost right in line with 12 months ago, with Yes, 12 months ago. So 52 weeks ago. And that was right before everything really shut down in the US. So gasoline demand is almost in line with where it was kind of pre-COVID shutdown. And it's interesting because the entire country hasn't, reopened. Everybody's not, 100% back to normal at this point. So it's interesting to see that. I think there's just a lot of pent up demand for people to just kind of get back to normal life right now. So, if that continues, that's probably a good thing for overall spending in the economy and things of that nature. So I mentioned small cap strength. Okay. So this is a chart looking back at each of the first quarter returns in small caps. Okay. So this is just small caps since 2006. So incredible strength in small caps. So like this top line here, this is since 12/31/2020, right? So it's the closing price of December 31st, 2020 to March 31st, 2021. So this is the first quarter of this year. So the second one would be the first quarter of 2019, right? And so forth. And you can see, small cap companies, kind of the backbone of the US economy. This is a really good thing. Like this is really bullish. This is great. But you can see like that's a huge run in 3 months. And so whereas, yes, it's a really good thing. If that were to continue, would that kind of push things to an overvaluation aspect if it continued at that pace? Like that's something that I'm kind of paying attention to. I just thought that was really interesting to really look at it from historical perspective, because you see, oh wow, small caps are doing really well. How does this compare to the last 10, 15 years, something like that? And yeah, small caps have just ripped. It's been incredible. So it'll be interesting to see what happens with that. I know that this week, large cap tech has actually done pretty well. I know specifically today. So you wonder if there's going to be a little bit of rotation, maybe from small caps back into, that tech space. So we'll see. I think this is a really good sign, but you don't want to see things go too far too fast. That can always create some issues. So kind of paying attention to that. This is the chart that I was telling about that I created. It's kind of an all asset momentum chart. Now I minimized it. I think there's 38 or 40 different categories that I put on here for this presentation, specifically so I could fit it on one page. The one that I actually look at is about 180 different categories. And I broke it down. So bonds is at the top. Here's like inflation, volatility, some cap weighted, right? So, large cap growth, large cap value, mid cap growth, mid cap value, small cap, and then just some sectors, and then energy, and then just some alternative investment space as well. And essentially, basically what you can see is, it's measuring momentum in each of those categories. Okay. And so obviously green is good, red is bad, right? The higher the number, the better, the lower the number, the worse. And essentially what it is there's two dates at the top here, okay? And data from, data for. Data from, it's where I'm pulling the actual data from. So like for this particular month, it's this data is the month ending March of 2021 going into April 2021, right? So if you were to say, hey, we're going to invest in like, the highest momentum, 5 highest momentum things each month or whatever, then, you'd be in, TNX, the S&P value, small cap value, financials, those types of things. You'd definitely stay out of convertibles, stay out of global clean energy. So you can kind of see, and it's interesting. So this is going back to obviously the beginning of last year, right? Here's the VIX, the volatility index, obviously showing a lot of momentum going into February was actually tops of the list. And then obviously going into March, which tops the list, as was, bonds, right? And then bonds have obviously didn't want to be in bonds over the summer, which makes sense because the market's ripped. I think the interesting thing when paying attention to this chart, kind of what's going on, bonds, whereas bonds are still not, performing all that well, on a relative basis from momentum aspect, they're showing a little signs of life. I'm not suggesting that they're a great place to be, today. But when you look at this, and then the other thing that's interesting is the two sectors that when the market is kind of topping out, the two equity sectors that typically perform the best are utilities and consumer staples, right? And so when you look at those two, which is these two right here, right, utilities and consumer staples, right, and obviously this makes sense. They didn't do very well during the summer months, right, because everything else, all the kind of risk on assets were doing really well, and they're starting to show a little bit more signs of life. Utilities and consumer staples are starting to show a little bit more momentum, and so when you look at that, coupled with the fact that maybe bonds are potentially maybe bottoming out in the short term, it's just interesting. It's like, okay, well, that, and then we look at the small cap, strength earlier. Are we gonna kind of head higher for a month or two, and then coming into kind of that seasonality, argument too? Or is it going to be a little bit of a rough summer? So I don't know. It's something that, paying attention to, just kind of follow the data. Let's continue to monitor everything. But you don't want to see, utilities and consumer staples crushing it if the market's going to, head significantly higher. You'd rather see other sectors do well, things like technology, consumer discretionary, things of that nature. And technology has started to do, better this week. So it's interesting. This is as of, basically April 1st. So I'm going to move on from here. Really quick volatility update. I try to do this, on each presentation here. VIX finally dropping to more normal levels, right? So we're at, like, I think 17.17 when I checked earlier this morning, and I continue to say, right, we want to kind of see that number come down. We're still high over, from a historical perspective. If I continue to always say you want to be down here, right? 2017, you want to be down here, that 2004 through 2006 region, and we're nowhere near there yet, but we're moving in the right direction. So hopefully we don't see volatility spike anytime in the short term, and it just continues to head lower. That would be very beneficial for the overall equity markets. And then this is just a chart. The VIX is plotted on the bottom, S&P 500 plotted on top, right? So S&P is in green, the VIX is in black. And just a really quick thing, just to show you that, yes, as volatility spikes, the market sells off, and typically it can be, pretty vast. So hopefully we continue to see the VIX come down to more normal levels. It's moving in that direction. That's a good thing. Okay, so I talked a couple slides ago about utilities and consumer staples, right? And if you go back to, it was either the February or the March webinar, I had this chart up, and I showed that this is a relative comparison chart. Okay, so this is taking the S&P 500 dividing by consumer staples. If the line is going up, okay, the S&P 500 is outperforming consumer staples. They could both be going up. They could both be going down during this time period. It just means the S&P is outperforming consumer staples, right? And so you can see that here, the dot-com bubble, right? When consumer staples outperform the S&P 500. Again, here we go, financial crisis. Consumer staples outperform the S&P 500. Consumer staples still went down here. It just outperformed the S&P 500. So with that in mind, right, again, it was either February or March, I had this chart up, and we were somewhere around here. And I had mentioned, I said, this whole relationship seemed a bit stretched. It wouldn't surprise me if, this change, we saw some sort of small correction, consolidation in that. And that's exactly kind of what happened, right? So consumer staples have started to outperform the S&P really short term. And I mean, that's nothing to, say, oh my gosh, let's go sit on the sidelines and run for cover. But again, it's one of those things that you pay attention to, like the momentum chart that I showed you with the different, green and red colors and things of that nature is, if enough of those things start to line up, then it really does make you kind of raise an eyebrow. So, and it's not just consumer staples, like I said, like utilities as well. Seeing, just seeing some more defensive sectors starting to show a little bit more strength. It might just be, hey, it's got to happen because, there's kind of air pockets in the market, right? Things have to settle down. Things have to kind of come back to a normal level. That's good. That helps make sure that bubbles don't happen or specifically don't happen too fast. So it's just something to kind of pay attention to. And, we'll see, is this going to be a consolidation, or is this going to be a little bit more of a larger correction coming? It'll be, really interesting to kind of pay attention to. You're really curious coming out of April going into May, where that momentum chart that I had that showed all those different asset classes, to kind of see how that changes. The US dollar versus commodities. So US dollar, UUP, is in black. DBC is a commodity index. It's a ETF. It's in green there, and you can see, inversely correlated, right? I mean, from a historical perspective, those two move in opposite directions. Now, it's not always the case, but historically speaking, that kind of does work out in that way. The interesting thing about this right now is that, both have been rising, this year. The dollar, I know the dollar's down today, but I know going into this week, it was up about 3.4%. Commodities have done really well this year, although they have, oil had sold off for a few weeks. And so the interesting thing is going to be really what, are they going to both move in the same direction? Or is one of them going to give, right? Are commodities a little bit stretched, and is that kind of, reopening and all that stuff going to slow down? This one is, I think the dollar is an interesting thing to look at right now, because it's not a really, it hasn't been an incredibly volatile asset to be into over the past few years, from when comparing it to, other asset classes. And with where bonds are and yields are people going to start to utilize currencies a little bit more for that part of their portfolio? You can go into the dollar, you can go to the Japanese yen, the Aussie dollar, the Canadian dollar. Canadian dollars were done really well because it's tied to energy so much. So it'll be kind of curious to see what happens with this over the next few months as well. This is the S&P 500. Okay, so is on the top. This is the S&P 500 black line. Bottom line is it's a momentum oscillator. Okay, it's called the RSI. It's Relative Strength Index. It has kind of an odd name because it's not relative to anything else. It's actually, all it does is it plots the most recent close, comparing it to closes over a certain number of periods, right? And then plots a line based off of that. And so really what you want to see is you want to see the RSI, the bottom line. You want to see it confirm, right, the SPX momentum. And so what these are called, this is called a negative divergence, okay? A negative divergence is when the S&P 500 continues to go up, right, when the momentum oscillator does not confirm it. The momentum oscillator goes down, okay? That's called a negative divergence, and that's not what you want to see, okay? So you can obviously see this time period right here. This is right before the financial crisis. Negative divergence, pretty big one happened there. Another one happened here. This is going into, and I've talked about this in the past, kind of an earnings, a huge earnings slowdown that happened in late 2015, early 2016. Right, market was continuing to go higher here, and momentum, based off of the relative strength index, was not confirming those higher prices. Right, those were going down, and it's fine for momentum to kind of come to a little bit of a halt if prices continue to rise, but you really don't want to see this go down as prices rise, right? Kind of similar situation here in 2018, 19. And then this is where we're at. So this isn't anything too concerning here, but you can certainly see S&P 500 screaming higher here, right? I mean, that's a pretty big jump over that time period. Not really confirming, not going down. So not necessarily anything like it is here, or here. But really would like to see the RSI kind of catch up with the S&P 500 from, the momentum kind of, catch up with the price there. And then this is a really quick chart of Apple, right? Just want to kind of go over, a 200-day moving average, okay? Because I'm going to show you guys kind of one of the tools that we use to manage risk. So Apple is the black line, right? So, and then the green line is just the 200-day moving average. So if the stock is above, we can measure positive momentum. Basically, below, we can say, there's negative momentum. Now, again, we don't use moving averages for individual securities because of whipsaws, but it's a great tool to use in another context to measure overall market or sector strength. So like you could essentially just say, okay, if you're looking to see, looking for positive momentum and saying, hey, which sectors are showing the most positive momentum, you could plot and say, well, out of all the, what percentage of stocks in each sector is above the 200-day moving average, right? So we look at it from the entire market aspect and say, okay, well, the S&P 500, right? Here's the percentage of stocks in the S&P 500 trading above their 200-day moving average, right? So this is plotted. The top line here is 100. This would mean every stock in the S&P 500 is trading above that green line. And then if it was all the way down here, like this is 2008, this would say that close to every stock in the S&P 500 is trading below the green line, right? It's trading below their 200-day moving average. So we plot this. It's a really good way to kind of measure how much strength is going on in the market. And we're at really high levels right now. We're at like 94, a little bit to be expected because we were so low, basically 12 months ago. So it was almost guaranteed that at some point, unless the market continued to sell off, that we were going to have this huge spike, right? At some point, because think about it from a mathematical aspect. There's 200-day moving averages. Those last numbers are going to fall off, right? And so, at some point we'll certainly, you'll go much higher, and at some point we'll drop here. So, how we use this is this chart on the bottom is just minimized from the one below, or I'm sorry, from the slide before. And then this is the S&P 500, right? And essentially, if this falls below 50% and is showing negative momentum, I throw a momentum oscillator on top of this, then you see these gray shaded areas. And so those would be the times to de-risk. This is when, hey, there's less than 50% trading above the 200-day moving average, okay? And it's also showing negative momentum. So saying that, hey, that trend could continue. And the shaded areas there are when you'd want to de-risk. And then that's it. I told you I was trying to get through this a little bit quicker. I know last time I was like 45 minutes. So I was trying to be a little bit quicker on this one. So kind of really quick things I kind of go over. The VIX, again, finally coming down to more normal levels. World reopening, expected global growth. That was kind of that first chart. Inflationary concerns, increased interest rates coupled with higher commodity prices. Small cap strength has been incredible. Really good thing, but could cause some overheating, possibly if that, momentum keeps going. Intermarket relationships still showing signs of risk on, right? But defense is still starting to show up, right? You go back to the all asset momentum chart that I showed with utilities, consumer staples, starting to show a little bit, more momentum. Bonds possibly bottoming out here. We'll see. The U.S. dollar versus commodities. Which one gives? That'll be really interesting to see what happens with that. I know I talked about this last month. Probably not bubble territory yet, but certainly things are in the background. And I don't know if that could be 2 months, that could be 6 months. Who knows? So we'll see. And then the RSI, right? We really want to see the RSI confirm the S&P 500 momentum, and that was this chart, right? So here's the RSI on the bottom, S&P on the top. We really want to see this, the RSI kind of continue upwards here. We don't want to see prices go higher and the momentum on that drop. That would not be something that would be bullish for the market. So that's it. Any questions for me?